For tonight, we're going to be talking about technical analysis for CFDs, Forex, and crypto trading. Now, remember, too many people think that technical analysis is just about indicators, like MACD and RSI and stochastics. But that's not true. That's only one sector of technical analysis. Now, tonight, when I use the term securities, when I'm really referring to any tradable financial instrument. This includes stocks, bonds, commodities, futures, indices, mutual funds, and options. Now, while I may imply a specific investment product, so like I may say CFD or I may say shares, I may say Forex, these investment concepts will work with any publicly traded financial instrument in which an open market exists. But it gets very, very boring if I repeat the same word over and over and over again. Or if I just say shares or stock prices, you need to know that I'm talking about any asset we're talking about. Because tonight we're talking about what's available on the ETX Trader Pro platform. Similarly, I'll intermix the term investing and trading. Typically, an investor takes a long-term position, while a trader takes a much shorter-term position. In either case, the basic concepts and techniques are basically the same. So, one of the big questions you might be asking yourself is, should I buy an asset today or should I sell it? What prices will it be tomorrow or next week or next year or an hour from now? Wouldn't investing be easy if we knew the answers to these seemingly simple questions? Alas, if you're attending tonight's class in the hopes that technical analysis has the answer to these questions, I'm afraid I have to disappoint you early, and it doesn't. There is no magical potion. There is no promise. There is no guarantee. In fact, there's not even an indicator oscillator pattern that will give you results in on a regular basis. It's up to you to put these together and back test them and test them and keep an eye on price action, because price action is ultimately what dictates what is happening in the market. And no matter what you're using, sometimes the market shift, and oscillators and indicators patterns that work yesterday don't work in the current market that we have. Okay. So if you're attending this webinar with those technical analysis will improve your investing or trading, I have good news for you. It will. Okay. It will help you make better informed decisions, but it's still not going to tell you what to do. You have to make that decision on your own. So use guys out there that are following somebody's system that tells you when this does this, that does that, and this does this, buy or sell. Just like a lot of you pay a lot of money to get signals. And most of you lose a fortune paying for these signals. Because the signals, even though that they might have done everything to predict the future, nothing can predict what's going to happen. Now, the term technical analysis is a very complicated sounding name for a very basic approach to the markets. Simply put, technical analysis is the study of price, with charts being its primary tool. In fact, a lot of analysts really call this chart analysis or charting. And some analysts will say, I'm a chartist or I'm a chart analyst, because they don't use the other parts of technical analysis. They don't use the stuff that's dropped below charts. They only look at things that are on your chart. Now, the root of modern day technical analysis stems from Dow theory, and it was developed around the 1900s by Charles Dow. And you all know who Charles Dow is, because you all know what the Dow Jones Index is. We all talk about what the Dow is doing every day. Well, that is Charles Dow. Now, Charles Dow's contribution to modern day technical analysis cannot be understated. His focus on the basics of security price movements gave rise to this completely new method of analyzing the markets. But what we have to keep in mind And even though there's millions and millions of traders, and just in the Forex market alone, something like $6 trillion being traded every day. The amazing part is the human element cannot be factored into any type of analysis. And therefore, we always have to be aware of price. Because the price of security represents a consensus. It's the price at which one person agrees to buy and another person agrees to sell. The price at which an investor is willing to buy or sell depends primarily on his expectations. You know, you tell me, when you go on the ETX Trader Pro platform and you decide you're going to go buy gold and you're going to trade gold to go up, it's based on your expectations. I could be sitting at the desk next to you and looking at almost the same things you're looking at, and my expectations might be that gold's going to fall. So it all depends on your expectations. Now, if you thought gold was going to go down, it went down. Hey, you were right. Thought gold was going to go up, and the gold went up. You were right. But it's all based on your analysis and then your gut expectation. But these simple statements are the cause of major challenges in forecasting securities prices because they refer to human expectation. As we all know firsthand, humans are not easily quantifiable or predictable. This fact alone will keep any mechanical trading system from working consistently. And this is one of the reasons when you see all this robotic trading or all these apps, okay, all this stuff out there, if there could be a robotic trading system, a black box system, or an app that would give you the right answer all the time, we'd all be billionaires because we'd only make the smart trades and the best trade. We'd only trade what the robot told us to trade, and the robot would never make a mistake, so he would always be right. But because humans are involved, I am sure that much of the world's investment decisions are based on irrelevant criteria. Our relationship with our family, our neighbors, our employers, the traffic, our income, our previous successes and failures all influence our confidence, our expectations, and our decisions. Now that sounds kind of ridiculous, but it's really true. You know, let's forget, you know, we are the retail traders. We only make up 6% of the traders around the globe, a small little market. But let's take a big hedge fund manager, you know, or a big bank Forex trader who's trading hundreds of millions, if not billions of dollars. Now, normally when he saw something develop for the euro, he'd be buying the euro. But the fact is, his wife didn't feel so good this morning and the baby was sick, so he got out of the house late and he got to work 15 minutes late and he was rushing and his parking space wasn't there. And he got in and his boss was hollering for him. So by the time he got his computer on his desk and got situated, he was already in a really bad mood. Well, the next half hour, his brain is working different than his brain was working 2 days ago. And this affected his decision. Maybe he didn't see a spike on the euro. Maybe he did. Maybe, you know, all their computerized trading alerts him something he didn't see. Maybe he was stuck in a meeting, or maybe he was just in a bad mood and didn't make many trades yesterday. Whatever it was, it's the human nature. Because security prices are determined by money managers as well as home managers, students and strikers, doctors and dog catchers, lawyers and landscapers, and the wealthy and the wanting. The breadth of the market participants guarantees an element of unpredictability and excitement. So therefore, no matter how complex your analysis is or how minimal your analysis is, it's only giving you a little bit of an aid, because eventually it's all coming down to prices. If prices are based on investors' expectations, then knowing what a security should sell for becomes less important than knowing what other investors expect it to sell for. That's not to say knowing what a security should sell for isn't important, but there is usually a fairly strong consensus of a stock's future earnings that the average investor cannot disprove. Now, to give you a good example, last year, it was third quarter, Walmart's earnings came out. They missed expectations. Their same stores were slightly down, just down a wee little bit. Their profit was down a wee little bit. And it surprised the markets because it wasn't what was expected. But everybody on that would have expected Walmart prices to fall. So the fundamental analysis would have told you the prices were going to fall. Everybody had bought up the Walmart stock before the announcement, so all the fundamentals were telling you they were overbought. Everything was telling you it had maxed out, it was at a resistance level, not breaking through. So everybody was getting ready to sell. What happened? Walmart prices rallied like crazy. Why? Because buried in this this earnings report, their online sales had skyrocketed. So even though they missed sales expectation, their footfalls or their store sales were down much farther than what the market was looking at, but it was offset by the huge growth in online sales. And that was a bigger positive than it was a negative that Walmart said. And so the market rallied because they want to see a shift to online sales. But could we have predicted this? No. So in my experience, only a minority of technicians can consistently and accurately determine future prices. However, if you're unable to accurately forecast price, technical analysis can be used to consistently reduce your risk and improve your profits. And one of the least used aspects of technical analysis is rolled into your risk management. Where to put your stop losses, where to exit the market, what tells you the market isn't doing what you expected. The best analogy, though, I can find, and I hate to do things using gambling and casinos because this is the biggest difference between Forex trading and gambling, is the fact that we can use lots of information and knowledge to make a decision, not the spin of a roulette wheel. But if you look at casinos and gambling as a business, because the house never loses. Why? Because the house consistently puts odds in their favor. But this is what you have to do. If you think of the markets being the house, or the markets being out there, you have to consistently find ways to move the odds in your favor and get high probability successes while minimizing your risk. Now, let's forget about blackjack and poker and gambling, but let's talk about casinos as a business. Okay. And one of the smartest things the casino owners did, not long ago, well, before my time, but not so long ago, is they turned roulette into a very successful operation for the house. How did they do this? By adding the 0 and the 00. Now, it slightly improved the odds by putting these two other numbers in there. And this is why they pay 0 and 00 pay 35 to 1. No, they pay higher than that. They pay higher than the regular numbers. But by having reds and blacks, because most gamblers bet on red and black, they don't bet on a number, and adding the green as a third alternative in there, they move the odds in their favor. So similarly, when an investor purchases a security, he doesn't know what the price, if that price will rise. But if he buys a stock when it's in a rising trend after a minor sell-off, and when interest rates are falling, he will have improved his odds of making a profit. That's not gambling, that's intelligence. Yet many investors buy security without attempting to control the odds. So, contrary to popular belief, you do not need to know what a security's price will be in the future to make money. Your goal should simply be to improve the odds of making profitable trades. That's not saying you're going to lose the trade or you're always going to win the trade, but if you can shift from 5 successful trades and 5 good trades and 5 bad trades, and you can change it to 5 1/4 good trades and 4 3/4 bad trades or losing trades, you shifted the odds in your favor. At the same time, if you can reduce your risk management and your risk in the marketplace so that on your losing trades, you minimize your losses, you can gain an edge. And that's what technical analysis will do for you. Now, I mentioned earlier, if we accept the fact that human emotions and expectations play a role in security pricing, we also have to admit that our emotions play a role in our decision making. Many investors try to remove their emotions from their investing by using computers to make decisions, just like in the long ago movie 2001: A Space Odyssey, where everything was done by HAL and AI. Okay? The fact is, mechanical trading systems can help us remove our emotions from our decisions. Computer testing is also useful to determine what has happened historically, but none of these automated trading methods can actually understand the people making up in the market, can't understand Donald Trump doing something crazy, can't understand the fear factor. They can only figure out what price is going to be after these get, but they cannot analyze price action on the charts. So we must be careful that our mechanical systems don't mislead us into thinking that we are analyzing a logical entity. So if you keep in mind that the markets are not logical. Now, this is not to say that computers aren't a wonderful technical analysis tool. Yes, they are miracles because they allow us to use the same data, to use the same complex analysis, get the same information and do the same number crunching and use the charts that hedge fund managers do, money managers do, put us on an even keel, which we didn't have when I started trading 40 some years ago. We didn't have this even keel because back in those days, we didn't have PCs, laptops, or anything else. You had a broker who had a huge room full of air conditioners cooling down his computer, and an old black, green and white screen that couldn't do it, could do bare, it took a team of programmers to write a little tiny program. Today, you can do everything and anything and build your own trading system by yourself. Download your own apps. Well, you can use MT4 platforms and put all the AIs and EIs on there. So computers are a great thing. But remember, technical analysis is based almost entirely on a very small set of variables. Because technical analysis only uses really 4 or 5 pieces of information. It uses volume. It uses either the open, the high, the low, or the close. And it might use yesterday's open or yesterday's high or yesterday's close or last month's low. But it only uses these few pieces of information. So we have many different fields that make up technical analysis. My favorite field, and the one I use the most, are patterns. I look for price patterns on my charts. So technical analysis involves looking at patterns in price history to determine the higher probability time and place to enter and exit a trade. As a result, technical analysis is one of the most widely used types of analysis. Now, there's lots of people out there who think RSI and MACD and stochastics outweigh everything else used in the market. But the 2 biggest pieces of technical information or 2 biggest fields are chart patterns and Japanese candlesticks. Now, technical analysis is a bit of a misnomer since it is really not that technical. A better name for the use of charts to make investment decisions might be risk-reward analysis or even market psychology. Sure, there are some complex mathematical concepts involved with some of the more esoteric indicators, but at its core, technical analysis is simply a method of determining if an asset is worth buying or selling. Once we identify this, we are way ahead of the game with regards to assembling a winning portfolio. So simply stated, technical analysis is the study of data generated from the market and from the actions of people in the market. Such data includes price levels that have served as turning points in the past, the amount of stock or contracts being bought or sold, and the rate of change in price movements over a given span of time. Technical analysis also attempts to measure the collective investor psyche, calling heavily on the psychology of crowds in the circle of greed and fear. If everyone thinks one way, the odds are that the market thinks the others are usually high. Now, critics will point out that forecasting future price movements based on past price movements is akin to reading tea leaves or divining the future from the textures of chicken entrails. Many of the high priests of fundamental analysis are quick to call technical analysis the financial world's alchemy. Indeed, chart watchers cannot predict the future any better than your broker, your spouse, or a Ouija board. Okay, but if I were to say to you, Amazon's doing a huge stock buyback, Jeff Bezos just made a press release saying their sales were 12% ahead of what it was expected, and they did this and they did that, and Amazon stock skyrocketed. Okay? That's fundamental analysis. Okay? That's easy. But what's going to help you decide what price you should enter the market, what price you should exit the market, where you should put your stop loss, and where the market will go, and how can you reduce your risk? How do you know when the market's turning against you and not just retracing? None of that can come from fundamental analysis. And because all of us are short-term traders, and most of us using leverage of some sort, we need to be able to put our stop losses. We need to be able to see exactly what the market's doing. And we only get that from technical analysis. So let's pull up some charts I've got set up here for you. Now, one of the best ways of using technical analysis, and as I said, technical analysis is anything and everything done on a chart. And you might say RSI and MACD and Williams percent R and CCI are all done on mathematical calculations, and they're numbers, and the number tells me to do something, but they don't. A number that just calculates something doesn't tell you to do anything. Okay. Unless you drop it on the bottom of the chart and see how that number is moving in comparison to where it was an hour ago or 2 hours ago. So all technical analysis is done on charts. One of the most popular is chart patterns. And as we can see here on this chart of Bitcoin, we see the price of Bitcoin moving into a triangle. A triangle is a well-known chart pattern, and it helps us understand the psychology of the markets. But if we don't even worry about that, what do you think is going to happen is prices get tighter and tighter price moves into the apex of this channel. It's either going to break out downward or it's going to break out upward. When it breaks out of that channel, we can then expect or can calculate the momentum. We can predict how far it should move. And we know exactly what's happening in the market. Okay. Now, that's a whole part of technical analysis. We have ascending triangles, descending triangles. We have symmetrical triangles. Then we have wedges, we have channels, we have pennants, we have flags. All of these are patterns that appear on the charts based on price action. And all we know is every time these patterns have appeared historically in the past, this is what has happened. Okay, whether it breaks up, breaks down, okay. And so by knowing how every time price moves into the apex of this channel, if it breaks out from that center point, we can then predict or forecast what we expect to happen. Now here we have the Euro US dollar chart. And in this case, we've now dropped 3 indicators. These are called technical indicators. And we have a whole field of technical analysis that covers technical indicators. In this case, we have MACD, RSI, and stochastics on our charts. Now, these are 3 of the most well-known technical indicators and will help us get entry points and exit points, will help us tell us when a market's overbought or oversold. Some are bounded oscillators and some are non-bounded oscillators. Okay, they all do different things, but that's just only one field of technical analysis. Then here we have a combination of MACD with simple moving average crossover strategy right on price chart and volume and our support and resistance lines. Different type of analysis. Here we have MACD again with trend analysis and our support and resistance. And now again, neither can tell us exactly what's going to happen. Neither can predict the future, but they can tell us what to watch for and what price is significantly important to the market. But all of these are valid ways of using technical analysis, from the most simple of just support and resistance line. But all of these fall into the area of technical analysis. And all of those, no matter which ones we were looking at, use the open, the high, the low, and the close. That's it. And volume. And volume is a very important number that we should, or open interest, because it lets us know how the traders are viewing the current market. So in other words, if you have a triangle and as the price gets in that apex and it breaks out and you see a surge in volume, that's going to help you know that that momentum of that asset, the breakout, is going to move in that, continue in that direction. But all the indicators use only that piece of information. So as we notice here, we have candlesticks and bar charts. Okay. Candlesticks and bar charts use the exact same pieces of information. They use the open, the high, the low, and the close. Okay. So even your charts only use this information. Now, technical analysis is the study of historic price action in order to identify patterns and determine probabilities in the future movement of the market. Technical analysis boils down to 2 things: identifying trends and identifying support and resistance through the use of price charts and or multiple time frames. Because remember, markets can only move up, down, or sideways, and prices are expected to zigzag. But technical analysis of marketing can help you determine not only when and where to enter a market, but much more importantly, when and where to get out of a market. Now, technical analysis is based on the theory that the markets are chaotic. But at the same time, price action is not completely random. In other words, mathematical chaos theory proves that within a state of chaos, there are identifiable patterns that tend to repeat. This type of chaotic behavior is observed in nature in the form of weather forecasts. For example, most traders will admit that there are no certainties when it comes to predicting exact price movements. As a result, successful trading is not about being right or wrong. It's about determining probabilities and taking trades when the odds are in your favor. Part of determining probability involves forecasting market direction and when or where to enter into a position, but equally in determining your risk to reward ratio. Remember, there is no magical combination of technical indicators that will unlock some sort of secret trading strategy. No matter what all those gurus on the internet are trying to preach to you, no matter all those systems and signals are trying to sell to you. The secret of successful trading is good risk management, discipline, and the ability to control your emotions. Anyone can guess right and win every once in a while, but without risk management, it's virtually impossible to remain profitable over time. So let's talk about how you can use all of this directly on the ETX Trader Pro platform. And I'm going to show you how to use it in the charts and how to put the indicators on your charts on Trader Pro. As you just saw, it's fairly easy to add the indicators and the technical analysis directly onto the Trader Pro platform. So remember, while professional technical analysis have dozens, if not hundreds, of tools at their disposal, it all boils down to 3 steps: seeing where a security is currently trading, figuring out how it got there, and determining the power of the trend and making comparisons of the asset to its peers in the industry, or even to its own history. Trends and trend lines are very important. Okay, there's no secret to finding a trend. If prices are generally rising and making higher highs as well as higher lows, then we have a rising trend, and knowing that is half the battle. Support and resistance, these are terms that simply tell us the price levels that are likely to bring out the buyers or the sellers respectively. Now we have in our Building Your Trading Foundations 3 classes for you. First, we have a 1-hour class on trends and trend lines. Then we have a 1-hour class on support and resistance and volume. And then we also have a 1-hour class on charts. Okay. Because there's lots of technical analysis out there you can get involved in. We have classes on MACD, RSI, stochastics. We have classes now on moving averages. Okay. But there's lots of esoteric stuff out there, people pushing out there, and there's literally hundreds and thousands of technical analysis. We also have a whole class on chart patterns where we just learn about each different pattern and what they mean. Now, we'll teach you in our moving average class as to what moving averages work best for our type of trading. Okay, how you would use a 20 period and a 10 period or crossovers, and how to calculate volume and momentum of an asset. How to look at relative performance. Because now that we have the theory and know the tools, you need to look at the idea of what's going to go into actually making a buy or sell decision. Because that's the hardest part, is how you would actually finally decide when all these things are telling you to do something is to actually buy or sell an asset. And then how would you put your stop loss and figure out your calculations? What should be your step-by-step process? And we also do that by developing our own trading plan. And we have a class next week, I believe it is, on building your trading plan. But you want to figure it out. Like, to determine the current trend is healthy, we want prices to be above a relevant moving average or near a breaking a support line or be in a pattern. Then we want to check the volume and the momentum to make sure they're holding up that pattern. Okay. And if the asset passes all those tests, then maybe we have a candidate to trade. But there's a lot of parts that we have to look at. Okay. And tonight was just a general introduction to the different types of technical analysis for CFD and crypto and Forex trading. So on that note, I'm going to say goodnight to everybody. You can see a recorded version of this class by using the same link. And the videos I showed you tonight, you can find on the ETX Capital YouTube channel. Thank you very much for joining us. Have a great trading day. And thank you for supporting ETX. Have a good night now.